You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hi, and welcome back to the Goldnomics podcast, where we look at global developments through the lens of precious metals. I'm with Stephen Flood, CEO of Goldcore, and Mark O'Byrne, Director of Research. And we have been looking at the attack of the zombie economy and how to protect your assets. This is in particular in light of the global pandemic that we are in at the moment with COVID-19. It's an unprecedented time in history from the financial global impact. We haven't seen anything like this since the Second World War, really, not in modern times anyway. And we've been looking at the impact on cash, we've been looking at the impact on bonds, and we've been looking at the impact on stocks. And what we want to do now is have a bit of a chat in relation to property, cryptos, precious metals, but also see, based on what we have been discussing, where we think things are going to be moving in the future, in the next 6 months, the next year. As anecdotally, I've been out shopping recently in a out of town shopping center, not too far, and having to queue up for 20 minutes to go into a shop. If you want to go into a number of different shops, you could be queuing for an hour if you're going into 3 shops or more, depending on. It's fundamentally and seriously going to impact the retail sector, and this is only a very small sector that we're looking at. That's
hospitality as well.
Yeah. But that's just in that's in the summer now, where it's nice and warm and it's not raining, it's not cold, and you're willing to queue outside a shop. As we go into later months in this year, and it gets cold, it gets miserable, you're going to see, people are only going to be going out for essentials. Right, they'll be planning their purchases. They're not going to want to go out and just browse around shops. A lot of shops aren't even allowing you to browse anymore, so that's not going to happen. Those kind of impulse purchases are going to start to dry up, and a large part of retail business comes from impulse purchases. We know that. But you're not going to go and queue for half an hour just to go browsing or make impulse purchases. That's all going to start to dry up. That has fundamental impacts on the turnover, the revenue of these companies. They have fixed costs to pay. They have large fixed costs to pay: rent, insurance, staff, rates, all of these things. That starts to come under pressure. They have big revenues to turn over just to cover fixed costs. And it has the knock-on effect of all of their suppliers as well. It has a knock-on effect for staff and wages and hours. So where are we going to? Steve?
It's a huge. It's you have a conflation of a number of different things. You have technology that's coming in. Amazon's and Instacart type companies are making incredible inroads into our local economy now that they wouldn't have before. They would have been they wouldn't have seen so much penetration, but now they're getting massive amounts of business. UPS is falling over. There's so much flow going through. A lot of packages that you would go local to buy are now being delivered to your door by a delivery driver, and it's it's great benefit to the consumer. They're getting a good service, cheap, deflationary effects. They're getting something more for their money in some cases, but it's actually going to cripple medium term the local economy. And what I want to talk about is what can we do as investors and how can we position, and even on a policy front, what can government do to support this new era? And I think there's a theme here, and I think it's local. So if you're looking for investments in equities, I think you need to investigate local companies, local businesses that are going to that you can understand. You can go and kick the door and kick the wall. The people, who's running it, the business model. You've looked at the books, the numbers. You're in for the long term. You support that company locally. I think the taxation system should also be supporting local businesses. There should be some sort of internet tax on transactions where you have a massive fulfillment center sitting in Birmingham, shipping out goods all over Northern Europe, and you have 10 people running it. I think that should be taxed. There should be some sort of redistribution of that benefit into society to support, because as Mark said, SMEs are the backbone to our modern economy. Services, restaurants, local small manufacturers, artisans, that's where a lot of people and families are supported. It may not fit into GDP as well and as efficient as other economic models, but it has a huge beneficial effect to society and our communities. So I think governments need to focus on a local taxation system that supports local businesses, and we need to shop local as well and invest locally. So looking at
you can see as well, you can see a lot of support for that, and you'll see it on social media, a lot of calls to when, the economy opens up again to start to look at your local suppliers. But just, I suppose, to challenge that idea as well, particularly, we're here in Ireland, and we do depend a lot on foreign direct investment. And we've got a very large technology sector and foreign technology sector. All the big names are here, and they provide a huge amount of employment.
Yeah.
What if everybody takes this attitude, and we start to see, as there's been movements or suggestions, they all start to move that investment back home, as everybody starts to focus on the local. How does that play out?
Well, I believe that that there's incredible latent creativity in populations of human beings when they come together to solve a problem. If you go to the mining towns of Northern England in the 1980s, and you told them you're going to take away their mines and for that mining coal, and everyone was employed there, and that was industry, there was no future per se. Some of these places are still devastated, but an awful lot of these places have reinvented themselves, and these cities have reinvented themselves. And there is a way. I think being nimble and being educated are two prerequisites to success. And if you can build that base in a local economy, have good universities, good colleges, and nimbleness and a good financial system, you can actually generate local industries that can be champions in that area. So I don't believe that we're beholden to large techs in Ireland only, and we have to protect that industry. I think that actually a lot of them have monopolistic behaviours and have actually reduced innovation in some respects, have had massive benefits in others, and have really brought us along. The information economy is vibrant. But just on that, I also think that I would also put it out to financial providers to produce products that actually celebrate local economy. In the bond markets, we should be able to buy local bonds that support local businesses at decent rates, and create that local apparatus to support our investment portfolios and get involved on that basis. There's no business in a Virginian investor having a bond that has money invested in the UAE or oil in Norway or something like that. It should be. I think the lion's share should be in a local in a local economy, and I think that's the answer for the future, because technology, local money, and people taking interest in their communities, I think, is the answer to where we need to go.
Mark,
I'd agree with that. Yeah. I mean, your point, Dave. The multinationals are important, and they do provide a huge amount of employment and tax revenues and all the rest. So it's about balance. I think that word balance is very important. That we need to get balance between the SMEs and the large corporates, not overly support or we sort of champion these larger corporations and we ignore the SMEs in many ways. So it is important to get that balance right. And when it comes to investing, I think that that balanced portfolio was always about you're buying global capitalism, and then you're going to get your 5, 6, 7% yield if you buy global capitalism efficiently, stocks and bonds. The data shows that you do tend to do very well for the long term. But given how dysfunctional that the whole political, geopolitical, economic landscape is globally, I think most people are, we're in a period of financial repression. We haven't really talked about bonds yet, but I mean, we have a bit. Bonds, I mean, obviously near negative interest rates on some 15 trillion plus of bonds. And there's also price risk there as well that people don't talk about. I mean, these bonds are at all-time record highs, and they could fall in the coming 5, 10, 20 years. The long-term investment horizon, most investors, they could fall 15 to 20% just or more in price terms alone, and you're not getting the yield. So it is all about that balance, that diversification, having your eggs in different baskets, but it's not as simple as before. Before, you could simply buy the index, buy that one global property index, buy that stock index, buy that bond index. I think as Stephen was saying, we're going to have to do a little bit more. I'm not even comfortable really with the whole stock picking thing, but I think we do have to do a bit of that stock picking now. If you're buying equities, maybe not stock picking, but you definitely have to look into the sectors and say, right, I believe that food is going to perform very well. We all are always going to have to eat. I think water is going to do very well. Agri. So there's certain energy. There's going to be certain sectors that are obviously more recession-proof and are counter-cyclical. And obviously precious metals. We'll come to precious metals in a second. So I think that, so the balanced portfolio of 60%, 40% doesn't make any sense. I think we spoke about it before, the Harry Markowitz portfolio. He had a portfolio back in the 1970s that performed extremely well during a very difficult economic time in stagflation in the 1970s. And he had 25% precious metals, 25% cash, 25% equities, and 25% property. And I think something like that, I'm not being prescriptive and I'm not giving financial advice. We're not regulated to give financial advice, but that's my personal opinion about, how, when I look at my meager wealth that I have, the small amount of money that's been come out of Goldcore over the years, that's how I look at it, and I practice what I preach, and I'm over allocated to precious metals because I believe they will outperform, and I think stocks and bonds are going to underperform quite significantly.
That's a nice segue into the topic of property. In this backdrop against the global pandemic, how does property perform in the short, medium, long term? I mean, it's the access to credit that we talked about doesn't seem to be for the mortgage market as much. And whether it's first-time buyers or people trading up, what's their access to credit going to be like for the foreseeable future, and how is that going to impact property? Obviously, if that part of the credit market starts to dry up, we've got significant pressure on house prices. Is that counteracted by other factors, or?
Yeah, do you want me to take that, Mark? Or?
Yeah, I don't mind.
Yeah. So just very quickly, a property technically it's like a utility play. It's prices derived from the cash flows it produces, which are compared to other risk-like options such as bonds and equities and whatever else out there. And so if you have a property and it's kicking back 100,000 in rent a year, it's an office or apartment complex, whatever it is, and your expected rate of return elsewhere is 10%. And to compare the price, the property should be valued at $1 million. So the factors that are going to affect you are the cost of credit, how much can you borrow and what rates and terms can you borrow at, how much the market is willing to pay you to rent that property, how productive those people are in that property in terms of what they're producing and their capacity to pay you rent. And these all get thrown in. So if you're to look at those ingredients, the economic potentiality of somebody using a property to create a return to pay you rent has to be questionable right now. You're in a pandemic, you're in a medium phase, so the earning power is now being repressed. So in that sense, property is going to go down, or prices should start to reduce in the medium term as a reflection of the economy. The cost of credit is also going down. That should allow people to borrow more money, and that could possibly increase property prices, and that's a factor up. The alternate argument too, in terms of where alternate investments are, bonds and equities. Well, bonds are very, very give you nothing. So property looks better favorable to bonds as a risk comparison. So you'd have to say property has maybe two factors for it and one factor against it. And the question is the economic fortunes of the economy going to improve, and the yield coming into property investments is going to rise? I think it's hard to to say. I think the jury is out on that one. But if I had to call, I'd say property is probably favorable over the next 5 years, and maybe even as a safe haven asset, as an alternate, because nobody wants to go into bonds and lose money, and equities seem completely crazy. What's happening there, and it could blow out. It could be a blow off, but it also could collapse very quickly too. So I think there's a place in a portfolio for it. Again, I would look at it. I'd be very, very diligent and look at those opportunities, and maybe place property plays in safer markets that have good credit terms, but also a good, robust economy that can support rents. It might be a little bit more boring. That's my.
And are you distinguishing there between commercial property and residential property in terms of your outlook?
Well, they should be connected in many respects, because the fortunes of residential should be related to the commercial aspects too. But then you could have economies, local economies are in different economic cycles. So you could be looking at a kind of a tiger economy in Asia or somewhere like that that has a very, very cheap labor force but has huge inward investment coming into it, and that might be an interesting play, from both a residential and commercial. But I would just be careful. I mean, again, diversify. It should be in your portfolio. Be a bit more choosy and consider what you believe those metrics will be in terms of that particular opportunity.
Yeah, I would broadly agree. I think I would be nervous about property in the short term. I think we are going to see inflationary pressures come in, because obviously the market just stopped. It was like a heart attack for the last 2 months, 3 months. There's nothing moving, and you would think anybody who was looking to sell beforehand, they are not going to be looking for any more money on that property that they have in the market. They would be willing to take, if they'd be delighted to take the price that they were looking for back 3 months ago. And I think a lot of them will be happy to take even a 5, 10, 20% discount. And the buyers will be looking to get a discount as well, So I think you're definitely going to see weakness come in both on the residential and commercial, because there's massive, as Stephen said, there's massive demand destruction, people have lost their jobs in their thousands, massive unemployment. People have gone home. We've all over the world, the big cities around the world, and these globalized Western economies have massive immigrant populations. Many of them went home to their countries, back to Brazil and South America and Asia and all the rest. And then people in the cities, a lot of them went back to their families in the countryside, particularly younger people in their 20s and millennials. That's going to have a massive impact on the residential side of things. There's less demand for property. And therefore, a buy-to-let investor will look at that and say, geez, am I going to get the yield here?
Yeah.
Just one other point on the commercial side of things, there's a similar thing that there's going to be less demand for offices, because, the entire business community, both SMEs and corporates, have realized, Jesus, we didn't need half the office space that we thought we needed,
Yeah.
So I think in demographics, people, I think when the value comes in, I think a lot of people will buy commercial, converted into residential, because we're going to have long-term, we do have these demographic issues, and there's housing issues in many big cities around the world. So I think there will be value there, but I do think there's quite a degree of weakness and potentially a crash. We could see falls as sharply as 2009, 2010, because momentum's a powerful thing both on the upside and on the downside, as we know.
There's also, and you mentioned it there, I mean, there's a fundamental potential for a societal change, a change in the way that we behave when it comes to working.
How we work.
Yeah, because so many of us now, and are working remotely, and many companies before this were against the idea of remote working, and for whatever reason said that they couldn't do it. It couldn't be done in their situation, but have been now forced to, as a result of this pandemic, having to embrace that. Right now, when we start to come out of this pandemic, as restrictions are eased, you're still seeing that it's not going back to where it was anytime soon. You've got staggered working hours, you've got alternate working days, you've less capacity in the offices. I think it was the CEO of Twitter recently who said that there are some people working from home now that will always work from home from here on in, working in Twitter. Now you say, well, what impact does that have? Has an impact on commercial properties, but it also has an impact on residential properties, as in, now that you don't have to be in the office, you don't necessarily have to live in the city close to where you work, or even in the suburbs close to where you work.
Yeah.
If you're only going into the office once a week or once a fortnight or whatever it is, or in certain situations like Twitter, where you're never going to be going back into the office. Well, it doesn't matter where you live then, as long as you have good Wi-Fi. That's what determines where you live, not being close to the office. And also, on top of this, I think that a lot of people have seen the negative side of living in a studio apartment or a one-bedroom apartment with a small balcony or no garden during lockdown. Now, a lot of people have no choice, but for those that do have a choice going forward, they may think twice about what is actually important, because this has been the ultimate black swan event, in the sense that for so many people, we now know that this can happen and could happen again. So it will fundamentally affect the choices that we make going forward. And that has to have has to have an effect on how we live. And how we decide where we want to live as well, which ultimately will start to impact the property market.
We've been, I've been in the office most days in the last 2 or 3 months, because we've clients who send us checks and we post coming in, and it was eerie in March, April. It was eerie because there was no one there except for myself and a security guard in this massive building, like six stories. So, but even now, in the last 2 or 3 weeks, when we were in there, and Stephen's been in there, there's little or no one in there, you know.
So I'm in here. Look around. Look.
Yeah, Stephen's there.
There's nobody. There's nobody here.
On the entire floor, and that's just one segment of the floor. And I've been told that Microsoft, who have a half or 2/3 of one of the floors there, they're not coming back at all. You know, they've basically said the staff can work from home. They've realised all the staff can work from home and not miss a beat. You know, in terms of, you know, service levels and phone calls, and we're the same as a company. You know, and it's a credit to Stephen and his technical news and how he has had us set up as a company, that we're all working from home within days. I'd say we were ahead of some of the corporates in getting our stuff.
Well, we were 2 weeks before the full lockdown came in. We were working from home, so it's really interesting. I think there's a lot of really interesting changes, but this is actually a long-term trend. It was a kind of a super trend that was going to happen with technology, because we all worked in offices. We worked in offices before because we were operating on a paper-based system, and the office is kind of like a hangover effect from that era. You had to have people in physical proximity to actually transact and do work. Now we've gone electronic in many respects, and so the physical proximity isn't important. But we never had the tools like Zoom and all these other tools, and we never embraced them as much on a management level to communicate and operate and manage. But there are questions being asked now, and answers are being developed as we speak right now. So we've gone out and surveyed our staff, and some of the anecdotal kind of responses so far are that people really like the idea of working from home. They're actually more productive at home. They save commuting time, which is a big win. You know, that hour and a half, 2 hours, 3 hours on a train, whatever it is. They also get to exercise more. They get to spend time with their families. They actually don't take as many breaks as they should do, which is something I'm kind of working on right now to try and encourage. And it changes the way we're going to operate. So I mean, in our little company, what we're looking at doing is probably having more people working from home, growing and expanding on that basis, and then having people meet up every month or two on an offsite somewhere at a hotel or somewhere in a resort, somewhere like that, and get that personal time together where we can have a pint, share, and have a laugh. Make fun of my shirts, all sorts of stuff, and I
wasn't going to say anything.
have that connection.
Not till the end. Anyway.
Yeah, listen, I lost the bet. Okay, so I had to wear the happy party.
It's laundry day in the flood house.
Party shirt. Yeah, I make it look good.
This is not the pink flamingo shirt.
Yes, indeed. And so, like, it's important though to have that physical connection, that time together, but also it's not necessary for actual productive work to happen on a day-to-day basis. And so I think we're examining these now, and I think it's a really exciting time. We won't travel as much. We won't use airlines. We won't go. When we do travel, it'll be for leisure and not business, for most part. Conferences are going to change massively. But hotels and places like that, like office blocks, as Mark said, or maybe you did, Dave, they're going to be reconfigured and repurposed for residential living, and maybe we'll have bigger workspaces or living spaces, which would be much nicer places to live. Our cities would be alive again. You go in on a Sunday in parts of cities around the world and they're dead. There's just wind flying through, streets, and there's nobody there because it's just office only. I think there's some really good things that will happen from this.
Yeah, I think that's a conversation in and out of itself.
Yeah.
But I want to just kind of bring it back to what we're talking about the rest of now. And before we talk finally about precious metals, I want to just very briefly talk about cryptos, or get your guys' opinion on cryptos, because cryptos is seen by some as the new safe haven. It's seen by others as a new form of cash, and then it's looked on by a lot of people very dubiously as well. How do cryptocurrencies perform in this environment going forward?
Mark, you go for
Who
that.
knows? Finger in the air. I mean, there's no track record. There's no previous performance. And nobody knows, including the Bitcoin evangelists, and they are very passionate in their beliefs. And who knows? They may be right in time. Bitcoin may become a safe haven asset, but the jury is very much out on it. And the notion that it's a safe haven, a proven safe haven, is absolute nonsense at this moment in time. It's binary. It goes to zero, or it does very well indeed. It could go to 50,000, 100,000 plus, if it survives. But that's the question, will it survive? Because a dollar crash is coming ultimately. And so there is a lot of truth to what the Bitcoin people and the crypto people say. They know that the monetary system, as we've talked about many times, is unsustainable and very vulnerable indeed. So it was actually Morgan Stanley, ex-Morgan Stanley economist during the week, Stephen Roach, highly respected guy, talking about the dollar crash coming. And, we've been talking about it for years,
I didn't hear that. He's amazing. Yeah, that's incredible.
Yeah, he's very, very respected guy. Yeah. So, the U.S. debt has gone up $2 trillion in the last 3 months. So it's not sustainable in any way. So that's their argument for cryptocurrencies as an alternative to the dollar and fiat currencies. But why they're jumping? Why not go to gold, which has actually been the currency and has been the form of money throughout the years, and all the problems that we've talked about in this podcast. If we had a gold standard, we would not have all these bubbles, all these imbalances, all the deficits, all the debt, the war, the economic destruction, because the gold supply only increases at 1 to 2% per annum. So therefore, your money supply only increases at 1 to 2% per annum. But anyway, I go off on a tangent. But the point I'm making is that gold is the true safe haven. Bitcoin, it could do very, very well, but it's highly speculative, and you've no business unless you have a very high appetite for risk. You shouldn't own Bitcoin. If you do have an appetite for risk, then absolutely get familiar with the technology. Buy, 0.5%, 1% of Bitcoin, but no more than that, because it is very risky. And Ethereum is quite interesting.
Half or 1% of your portfolio is what you mean by that.
Yeah, exactly. I mean,
so
very,
tiny amount.
Exactly. But see, I think you have to see it as it is a form of a hedge as well. But no, sorry, potentially it's a form of a hedge. But if it goes to zero, it's not a hedge. So gold can't go to zero or silver. We're going to come to that in a second, obviously. So there's a tiny place for them in a portfolio, but they should not be seen as a safe haven just yet.
Steve, very quick, brief comment on crypto.
Yeah, so it's I'm you guys know I love technology. I love the enabling power of technology and what it can do. Bring people ideas together. I look at crypto as being an extension of blockchain technology, and blockchain technology is transformative. It is like we've invented the wheel. It's going to change everything and every aspect of our lives over the next X number of years. Crypto is an extension of that. So it's a use case for blockchain technology, which is an immutable database that can't be just interpreted. It is what it is. Blockchain is a way of recording information that can't be recoded. It's specific and trustworthy by definition, and it'll change how every company operates. But crypto, there's a huge amount of speculative activity in crypto. People think it's a currency, but they're not using it to exchange goods. They're using it for the most part, to actually buy and hold, and hopefully it's going to go up. For me, it's a complete speculation at the moment. That there is a massive opportunity to use crypto technology as a currency or in currencies, whatever the form that they take, whether it be the dollar or euro, any currency. And in doing so, they will actually be able to encode and engineer into that currency aspects of the gold peg, and a gold-backed currency. So things that would prevent abuse, prevent printing money in all but the most exceptional circumstances. And so you can have crypto could actually take a lot of learnings from gold-backed currencies and apply it to the world today and create stability as a result. So I don't think we go back to a gold standard, but I think we can actually learn from it. I think for cryptocurrencies to persevere and succeed, they have to have massive regulatory support. And at the moment, regulators are, talking the talk in terms of, oh, we're very forward thinking and we're going to support this. We're going to have like an intellectual hub to support fintech and crypto. But ultimately, they are scared of it. They look at it as a way of losing control of their economies and some of the levers that they use to manage economic activity. So I don't think it has reg support yet. It needs that in order to succeed. It's an absolute prerequisite. It's not going to succeed in a vacuum. I think there has to be adoption of cryptos within an economy, in terms of currencies. When you start paying for your pizza with a crypto unit, or maybe a stable coin or something like that. Stable coin is a function of crypto and regular currencies. And so you start paying for that through your Revolut account or your bank account for that pizza using stable coin as opposed to a currency. Then it's actually, you're getting adoption. And that's actually a key to success. You have to see that. It also has to be safe. The operators behind cryptocurrencies have to be seen to be safe. I don't think that it's at all got that. And I don't think you're going to have any kind of widely adopted cryptocurrency that is operated by a nondescript group or population. Bitcoin has major problems in terms of miners taking control, splits within the currency, forks, whatever you're calling it. And there might be real good reasons for that, but it also undermines its tenure, its safety in the eyes of the public. And you just don't know what currency version is going to be here in 5 years or 10 years. If they're always changing, it's not going to have staying power. So yeah,
what
reg adoption
is going to be. What exchange is still going to be in existence, like Mt. Gox? Yeah.
Totally. But I take on Mark's point. I think 1.5% of your speculative component of your currency, throw it in there into a basket, and you know what, one of them might be an absolute winner for reasons that we could never foretell now. And but I do think it's an evolving area.
Okay, well, listen. Any conversations about this? It's not going to be complete unless we actually talk about precious metals. Precious metals. In an environment like this, where we have got massive money printing, where we've got money looking for a steady home, gold, silver, precious metals complex in general looks like the perfect home. We haven't necessarily seen the moves up that some were speculating would happen in the short term. We're still not at all-time highs in US dollars. We are in a lot of currencies, and you would think that the current environment that we are in would be a more precarious environment than we were in when gold made an all-time high in US dollars. What's the outlook for gold in this environment? Mark?
Yeah, it's very, very good. Yeah. But potentially you couldn't invent a more bullish scenario for gold. It's arguably as bullish as it was in the early 2000s, or after the Lehman Brothers blew up in late 2008. I think we're sort of that's the outlook. It's very, very positive indeed. And yeah, it's surprising it hasn't. I mean, it's only up about 8% in dollar terms. So, but it is the top performing asset in the world, along with 30-year bonds and the 10-year, the US 30-year, the US 10-year bond is the best performing asset in the world. And that's building on the gains that we've seen last year. So yeah, I mean, I don't want, at the risk of repeating myself and risk of repeating ourselves, it is a hedging instrument, a safe haven asset. All the academic research is there, all the asset allocation, those experts in the asset allocation sector, the research is there showing that. Well, I think as importantly, and potentially more importantly, in this era of financial repression, where you have negative yields on bonds and negative yields potentially on deposits, and we spoke about the risk with cash and the risk with bonds. I think the most important asset potential of gold is as a source of returns. And there's great research put out the World Gold Council recently looking at gold as a source of returns. and it's just very, very strong. It's done roughly 10% per annum over the last 15 years, the last 25 years, the last 50 years since 1971. Roughly 10% per annum in all currencies. It's done slightly less in dollar terms. I think it's about 9.5, 9.6% per annum in dollar terms, because the dollar's been the strongest currency in the world. But in British pounds, which has been a weaker currency, it's up 11.5% per annum. So I think that is the fundamental thing. And I think gold's going to do, at the very minimum, it's going to do that again in the coming months and years. So even if you're skeptical of Goldcore, because we're a vested interest and we say gold's going to go to $3,000 per ounce, $5,000 per ounce, we don't know, and we always put the caveat.
Well, hold on there. Mark, do you own gold? Do you own gold?
I do.
I own gold. Dave, do you own gold?
I do.
So we're not just selling. We believe in it, you know.
Well, absolutely. We practice what we preach. So, and the bottom line is, currencies are going to be devalued very, very sharply. So it doesn't matter what the gold price does. It doesn't matter what the stock market does. What the Dow Jones at 30,000, 50,000, 100,000. It matters what is the value of the underlying currency that these assets are denominated in. And that's the thing about gold and silver. They're a hedge against currency devaluation. And we're going to see that very significantly indeed. And I think the price will go parabolic at some stage. And that's when you should be, right now, you should increase allocations to gold and silver, because silver is even more undervalued than gold. And gradually, as we go forward in the next 2 years, 5 years, 10 years, you need to, gold outperforms, you'll reduce the allocations and you'll put it into assets that are undervalued and have an intrinsic value. And I think that's the way to do it. So you're not speculating. It's a diversified portfolio. You're slightly overweight in precious metals in the short term, with a view to taking profits along the way and reallocating then into other assets.
Yeah, I mean, like for me, it's like you buy a car. You put a lot of effort into it. You buy a car, it has to be a good car. You don't want to put really crappy tires on it, because if you do, and the unexpected happens and you have to turn quickly or something like that, the tires don't work, you lose traction, you crash. By having gold in your portfolio, it's like those tires on a car. You get really good quality tires. It gets your portfolio where it needs to get to. It's safe. It becomes your best friend at the most unexpected of times. And it's a foundational asset. And that's what it is. It's insurance. You're paying up, you're having something in there that's valuable inherently. And it's almost like a bet against the kind of the corruption, the potential corruption within a human-based system, and the futility of some of the policies that humans have, and our history tells us that we've gone off the rails many times, and not by design, typically just by pure ignorance and stupidity and greed and whatever and corruption. And so by having gold, you actually personally create yourself sovereign. You get personal sovereignty that protects you as an individual and your family. That's what gold is. It can't be printed. It sits there. If you look at it in terms of cryptos, like I looked at cryptos there and I said, hey, it needs regulatory support. Gold has regulatory support. It's used by the regulators, by the people who underpin the system and manage it. So it's massively adopted by regulators, central banks. It's adopted by the markets. It's a very, very well known throughout history, throughout all cultures. Indians, Chinese, Europeans, Americans, everybody understands the value of gold throughout history, always have. And it's safe. You can hold gold by its very nature. It's physical. It's a physical thing. It sits in a vault. It's not being corrupted in any way. It doesn't have anyone else. It's not a liability to anyone else. It sits there and it has no utility as an investment. It doesn't create any return. It just sits there and costs money to store. But it as a backdrop to all of the other active components in a portfolio that are productive, it's a diversifier, because it actually is negatively correlated. It means if they go up, it goes down. If it goes down, they go up, and in that way, it actually reduces the volatility in a portfolio. So the magic outcome from any portfolio construction process is to reduce volatility, that is the shakiness in a portfolio, so you have a nice smooth line up, hopefully, and to increase and optimize returns. And gold over 5, 10, 15, 20 years in most currencies will take a diversified portfolio and actually reduce volatility, it's been proven, and increase returns just by a marginal amount. But in those shaky times when you have huge recessions, it really comes into its own, and it stops you freaking out as an investor and selling off your investments at rock bottom prices emotionally. Once something you have in that portfolio will start to rise. And the World Gold Council have done amazing research in this regard. You can go onto their site gold.org and actually and download their research. I'd say financial planners should all have 5-10% of their portfolios for their clients in gold, and have in safe jurisdictions, not in ETFs, not in digital gold per se, unless you're speculating. They're fantastic ways of speculating. They're really cheap to own and sell and hold. But for long-term purposes, you need to hold physical, segregated, allocated gold in a safe jurisdiction in a vault with no banks anywhere near it, and it sits there and it just retains its properties, and those properties are what delivers value into a diversified portfolio.
I can't think of a better way to bring this conversation to a conclusion than that. I think it's a fantastic summary of the benefits of precious metals in a portfolio. Yeah. This has been, as usual, a fascinating discussion. We've looked at the zombie economy, attack of the zombie economy, and how to protect your assets. We looked at cash, we've looked at stocks, bonds, property, cryptos, and finishing off here with precious metals. Before I say thank you to Steve and Mark, I just want to remind everybody that this was part 2 of a 2-part podcast. And if you haven't managed to catch part 1, go back and listen to that or watch that now. And also, I want to remind everybody to subscribe on YouTube, on SoundCloud, on iTunes. Hit the notification bell so you get notified every time that we do upload new content. And also subscribe to our market updates on goldcore.com. I want to say thanks to CEO of Goldcore, Stephen Flood, and Director of Research, Mark O'Byrne. Gents, thanks a million.
Thanks, David. Thanks, everybody.
Discussion.
Thanks, Mark. Thanks, Dave.
Thank you.
Thank you so much.
And everybody, stay safe, and we shall be back with you very shortly. Thank you very much.